So everyone's blaming whales, the Fed, maybe some grand manipulation for Bitcoin's huge crash. Well, they're all wrong. The real reason for that massive drop isn't some villain, it's the system. And trust me, understanding what actually happened is going to change how you see crypto forever. Let's break it down.
Okay, so Bitcoin plummeted from over $126,000 all the way down to $60,000. I mean, that's a staggering 52% drop. It wiped out months of gains in a flash. But what if I told you this wasn't some attack or manipulation? What if this was the new financial plumbing for Bitcoin, working exactly like it was designed to?
Right, so the culprit wasn't some shadowy figure in a back room. Nope. The real cause is Bitcoin's brand new integration into institutional finance, all thanks to those new ETFs. It's a total game changer, and it means the old rules, well, they just don't apply anymore.
Now, to really get what happened, we've got to start with the central mystery of the crash, a paradox in the data that at first glance makes absolutely no sense.
Okay, so check this out. A few days before the big crash, Bitcoin dropped about 6%. And look, over $500 million fled the ETFs. Classic panic selling, right? It makes sense. But then on the day of the massive 13% crash, with record-breaking sell volume, the ETFs saw over $300 million in net inflows. Money was actually coming in while the house was burning down. How is that possible?
This is the big question, isn't it? If the market was in a state of just sheer panic, with everyone smashing that sell button, how on earth could hundreds of millions of new dollars be flowing into Bitcoin ETFs? You know what? This single question unlocks the entire story.
All right, before we get to the answer, we need to clear the air. Let's just get rid of all the simple, easy, but wrong theories that have been floating around.
You've heard them all, I'm sure. A giant whale decided to sell their bag. A fund in Hong Kong got caught in a bad trade and just blew up. Or my favorite, it was a coordinated attack to shake out all the retail investors. These are nice, clean, simple stories. They just don't fit the facts.
The data just doesn't back any of that up. I mean, there were no massive wallet movements to suggest a whale dump. And the way institutional options trading works makes that fund collapse theory pretty much impossible. The truth is, way more, well, systemic.
So, if it wasn't a single person or a single event, what was it? The real reason for the crash is Bitcoin's new home. It now lives inside the complex, automated, and often brutal world of institutional finance. This right here is the single most important idea you need to grasp. Since the ETFs launched, Bitcoin is no longer just some crypto asset floating on its own. It's now what they call an institutional risk component. Think of it like a document in a filing cabinet. Bitcoin is now in the same cabinet as, say, high-growth software stocks. So when a risk manager decides to just pull that whole cabinet off the wall, everything inside, everything falls out together. And the data proves this. I mean, look, in recent weeks, Bitcoin's price moved in almost perfect lockstep with software stocks, the other stuff inside that institutional portfolio. But its correlation with gold, which isn't in there, much, much weaker. You see, Bitcoin wasn't sold because of Bitcoin. It was sold because it was in the same book as everything else that was getting cut. Now, that initial selling, that was just the trigger. What turned a simple dip into a violent crash was a series of automatic, pre-programmed reactions that created a brutal domino effect. It all happened in 4 purely mechanical steps. First, the price drop triggered automatic stop losses across countless funds. Boom. Second, banks that had sold Bitcoin products had to algorithmically re-hedge their books. Now, in a falling market, that means one thing: selling more Bitcoin. Third, all that new selling pressure forced leverage positions to be liquidated, which, you guessed it, created even more selling. And fourth, as volatility just exploded, automated risk protocols kicked in, and they're programmed to do one thing and one thing only: cut exposure. This wasn't malice, people. It was just math.
You know, the best way to picture it is like a revolving door. When everyone tries to rush through it all at once, it doesn't spin faster. No, it jams, it gets stuck, and then it just spins wildly out of control. The entire system was pushing in one direction at the exact same time.
And right here, this is the smoking gun. A really popular institutional strategy is the CMA basis trade. Basically, funds buy spot Bitcoin through the ETFs, and then they short the futures to collect the price difference, the spread. Well, during the crash, as all these positions were forcibly unwound, that spread just exploded from about 3% to a massive 9% in a single day. That right there is the unmistakable footprint of the institutional cascade.
And this finally solves our mystery. Those positive ETF inflows, they weren't new investors heroically buying the dip. Not at all. The selling pressure was just so intense that it literally overwhelmed the system. Market makers, in their automated quest to keep things stable, created this temporary glitch where new ETF shares were created just to absorb all the selling. And that registered as an inflow, not because of new buyers, but because the plumbing itself was breaking under the pressure and then frantically repairing itself.
Okay, I know that sounds absolutely terrifying. But here's the part that most people are completely missing. Everything I just described, that whole automated cascade that shoved the price down, it works in the exact opposite direction too. It's a perfect mirror image. A price drop triggers automatic selling and forced unwinds. But a price rise, that triggers short squeezes, forced buying from liquidated shorts, and a complete reversal in that algorithmic hedging where the dealers are forced to buy into a rising market. The system is perfectly symmetrical.
Think about it this way. The 2017 bull run was fueled by retail fear of missing out. The next major rally, though, it could be fueled by systematic, algorithmic buying from the most powerful financial institutions on the planet. The very same infrastructure that makes crashes more violent can make rallies way more explosive.
So what does this all mean for you? It means Bitcoin is a fundamentally different asset now. It's an institutional product. That means crashes and rallies are going to be faster and more violent. This volatility you see, it's a feature of this new integration, not a bug. And it means understanding the nuance of ETF flows is more important than ever before.
So here's the final takeaway. The very things that make Wall Street systems so fragile, the margin rules, the automated hedging, the crazy feedback loops, can actually make Bitcoin stronger and its price moves more extreme in both directions. It literally feeds on the system's own fragility.
So the question is no longer about which whale is going to sell. It's about the system itself. We just witnessed a massive, violent rebalancing. The only question now is, which way will these incredibly powerful institutional dominoes be programmed to fall next?
Be honest. When this crash happened, what was your first thought? Did you blame whales and manipulation, or did you have a feeling that the system itself was at play? I'd love to know. Let us know down in the comments.
The entire market structure for Bitcoin has fundamentally changed. So, if you want to keep up with the new rules of the game and really understand how institutional finance is reshaping crypto, make sure you subscribe. We're just getting started.